Welcome to a deep dive into the world of fundamental analysis.
Mm.
You always hear that you should invest in what you understand, right? Well, today, we're going to go behind the scenes
Okay.
to see exactly how the pros analyze companies. Think of this like a crash course,
Mm-hmm.
straight from a Brazilian MBA program.
Nice.
No boring textbooks here,
Yeah.
just real-world insights from a professor's slide deck.
What's really cool is that we get to peek into this course called Valuation, ANÁLISE Fundamentalista I,
Oh, wow.
which translates to Valuation Fundamental Analysis I.
Very cool.
And it's this unique window into the tools and strategies these finance wizards use to make investment decisions.
And you know me, always hunting for those hidden gems.
Yeah.
This whole deep dive is about separating fact from hype
I like it.
and finding those companies that are truly worth investing in.
Awesome. So it all starts with understanding what fundamental analysis is.
Okay.
The course kicks off with this quote from Graciano Sá. He's a big name in Brazilian finance.
Gotcha.
And he says, a company's real value isn't just what it's worth today,
Okay.
but what it can deliver to investors in the future, and that this value can be figured out analytically.
So, like looking into a crystal ball, but instead of magic, we're using like numbers and analysis.
Exactly. It's about more than just looking at the assets of the company today or the profits,
Sure.
anything like that. It's about understanding the potential, the future prospects of the company, even the quality of the management team.
Okay.
Think of it this way. In horse racing,
Okay.
you wouldn't just bet on the current leader,
Right.
the true fundamental analysts.
Yeah.
They look for the dark horse, the one that has the potential to blow past everybody else.
Oh, so exciting. Finding
Yeah.
those undervalued companies
Yeah.
before everyone else catches on.
Right.
But how do we actually spot those?
That's where this concept of margin of safety comes in. So it's all about finding companies where the market price is lower than what we calculate their true or intrinsic value to be. And that difference, that gap,
Okay.
is our margin of safety.
Gotcha.
It's like having a buffer
Yeah.
to protect us from potential losses.
So it's like finding a dollar on the sidewalk
Yes,
for 50 cents.
you got it. Now imagine a graph.
Okay.
You got time on one axis, and you got both the company's intrinsic value and its market price on the other.
Okay.
Now, in a perfect world,
Yeah.
those lines would be the same,
Right.
but in reality,
Yeah.
they often diverge.
Mm-hmm.
And those moments, when intrinsic value is higher than the market price, that's where savvy investors
Okay.
can find opportunities.
So fundamental analysis is about digging deep into a company's financials,
Yes.
looking for that margin of safety.
Exactly.
But wait, isn't there another approach, something about like charts and trends?
Right. You're thinking of technical analysis.
Oh,
It is a different beast altogether.
Uh-huh.
Technical analysts focus on patterns in stock prices,
Okay.
trying to predict future movements
Yeah.
based on past behavior. They might not even look at the company's financials.
So it's like reading tea leaves versus doing a full medical exam.
That's a good analogy. And the course really emphasizes the different mindsets.
Okay.
Fundamental analysis.
Yeah.
It's for the patient investor, the one who's in it for the long haul.
Right.
It requires discipline, independent thinking,
Uh-huh.
and a willingness to do the research.
So it sounds like fundamental analysis is more about understanding the why behind the numbers.
Yes,
Whereas technical analysis is more focused on like the what.
precisely.
Okay.
And this long-term approach, it can have some interesting advantages.
Like what?
The course tells this story about two investors. Tim, the day trader who's always chasing quick profits, and Lucy, the patient fundamentalist who carefully selects companies and holds them for years. Guess who ends up paying less in taxes?
I'm going to guess Lucy.
You're right, because long-term capital gains often get preferential tax treatment.
Interesting.
It's a subtle but important perk
Yeah, definitely.
of the fundamental approach.
Smart move, Lucy. So the course lays out these 10 fundamental principles of finance.
Yeah.
But let's just focus on a few
Okay.
that are especially relevant for us today.
Sounds good.
First up, understanding those financial statements is key.
Absolutely.
Luckily, we're already on the right track with this deep dive.
I think so too. The next principle really hammers home the importance of finding assets that actually add value. Remember that margin of safety.
Yeah.
It's not about buying just any stock.
Okay.
It's about finding the ones that are truly undervalued
Mm-hmm.
and have the potential to outperform.
Okay. And it wouldn't be a finance discussion without talking about risk. So Principle 7 reminds us that risk and return are two sides of the same coin.
Yeah,
Higher potential reward usually comes with higher risk.
exactly.
And then that brings us to Principle 8, which I find pretty intriguing.
Okay.
It acknowledges that markets are generally efficient,
Mm-hmm.
meaning prices tend to reflect all available information.
Right.
But it also suggests that there are still opportunities for those who dig deeper,
Yeah.
those who are willing to put in the work to find those mispriced assets.
Absolutely.
So even in this age of instant information, there's still room for that, like sharp-eyed analysts to find hidden value.
Absolutely. It's like panning for gold.
Yeah.
Most people, they see just dirt and rocks.
Right.
But the skilled prospector knows how to spot those nuggets.
I like that. Okay, I'm feeling inspired.
Yeah.
But before we go rushing off to buy stocks,
Yeah.
the course introduces this concept of the corporate life cycle.
Right.
It's like a company's journey from birth to maturity.
Mm-hmm.
And it seems to play a big role in how we value them.
Right. The life cycle is represented by a graph
Okay.
showing revenue over time with distinct stages.
Mm-hmm.
So you have the initial high growth phase, followed by more moderate growth,
Uh-huh.
then stability, and eventually decline.
Okay.
And what's fascinating is that different valuation methods
Yeah.
and investment strategies
Yeah.
are appropriate for each stage.
Gotcha.
So like a young, rapidly growing company
Mm.
might be better suited to a discounted cash flow analysis,
Okay.
while a mature, stable company
Yeah.
might be more appropriately valued using multiples.
Ah, so it's not a one-size-fits-all approach.
Exactly. And speaking of approaches, let's move on to the heart of the matter. Creating and measuring value.
Okay.
This section emphasizes that it's not just about top-line growth.
Mm-hmm.
It's about understanding a company's strategic position, its ability to generate profits,
Okay.
and ultimately its capacity to create value for its owners.
That makes sense. I mean, a company that's growing but not making any money
Right.
isn't really creating value.
That's a key takeaway. There's a quote in the course that really drives this point home.
Okay, what is it?
My great-grandfather measured performance by revenue growth,
Uh-huh.
my grandfather by profit generation,
Okay.
my father by cash generation,
Mm-hmm.
I by value creation.
I like that. It shows how financial thinking has evolved over time.
Right.
We're not just focused on growth anymore, but we're looking for sustainable, profitable growth.
Yes,
That translates into real value for investors.
exactly. And to help us measure this value creation,
Yeah.
we'll dive into two key metrics in our next segment, EVA and MVA.
EVA and MVA.
Yeah.
Sounds intriguing. But we'll have to save that for part 2.
Yes.
Join us then as we continue our deep dive into fundamental analysis, exploring the tools and techniques
Absolutely.
that can help you separate the winners from the also-rans
Yeah,
in the stock market.
for sure.
Welcome back to the deep dive. Ready to unpack those two intriguing metrics, EVA and MVA.
Absolutely. Let's start with EVA, which stands for Economic Value Added.
Okay.
And this metric, it cuts through the noise of traditional accounting
Mm-hmm.
and focuses on the true profit a company generates after considering the cost of its capital.
Cost of capital, meaning like the money a company needs to raise.
Exactly.
To operate and grow.
To operate and grow, yeah. Think of it like this. Every dollar a company invests
Uh-huh.
has an opportunity cost.
Right.
It could have been used elsewhere, earning a return.
Okay.
EVA helps us see
Yeah.
if a company's return on investment
Mm.
is actually higher
Okay.
than that cost of capital, indicating true value creation.
So if a company's EVA is positive,
Yes,
it's a good sign.
it's a good sign.
It means they're using their money wisely to generate profits above and beyond what investors expect.
You nailed it. Yeah, it's a sign of efficiency
Okay.
and a strong management team that knows how to allocate resources effectively.
Okay. EVA, I think I got it.
Okay.
Now what about MVA?
So MVA, or market value added, takes a broader view.
Okay.
It looks at the difference
Mm-hmm.
between a company's total market value and the capital invested in it.
Okay.
Think of it as the market's vote of confidence
Okay.
in a company's ability to generate future EVA.
So a high MVA means the market believes the company will continue to create value,
Yes,
even like years down the line.
exactly. The market is essentially saying, We believe this company has a bright future and will deliver returns that exceed the cost of capital.
Ah, I see.
See?
Investors are betting on the company's long-term potential.
Yeah.
Now, to calculate these metrics,
Yes.
we need to, dive into the nitty-gritty of a company's financials.
Right. We need to understand how a company generates cash flow,
Okay.
which is the lifeblood of any business.
Right.
The course material, it takes us through a company's income statement.
Oh.
Okay, step by step.
Mm-hmm.
It's a fascinating journey from revenue to net income,
Right?
highlighting how value is added along the way.
So we start with revenue,
Right.
the total money a company brings in.
Exactly.
Then we subtract the cost of goods sold,
Yes.
which includes things like raw materials
Uh-huh.
and manufacturing expenses.
Right.
That leaves us with gross profit.
Correct.
But we're not done yet.
We're not done yet.
We still need to subtract those operating expenses.
Yes.
Like salaries,
Mm-hmm.
rent,
Yep.
marketing,
Uh-huh.
and research and development.
All those is.
Those costs of keeping the lights on
Yeah.
and the innovation flowing.
Yeah, keeping the engines running.
What's left after that?
So then we get to EBIT,
Yes,
earnings before interest and taxes,
exactly.
which tells us how much profit
Yes.
the company generated
Uh-huh.
from its core operations
Right.
before taking into account any financing costs.
Precisely.
Okay, EBIT, key number.
Yes.
But we still need to factor in those pesky interest payments
Right.
on any debt the company has.
So then we subtract interest expense
Right.
to get our earnings before taxes, or EBT.
Yes.
And then finally,
Finally.
we deduct taxes to arrive at our beloved
Yes.
net income. The bottom line,
The bottom line.
net income, the ultimate measure of profitability.
Right.
But remember, we're on this quest
Yes.
to understand cash flow.
Cash flow. Right.
So how do we get there?
Excellent question. Net income, it's an accounting measure.
Okay.
But cash flow, that's the real deal.
Yeah.
It represents the cold, hard cash a company generates and has available to reinvest,
Uh-huh.
pay dividends, or reduce debt.
So it's about understanding where the money is actually going.
Exactly. To calculate free cash flow, which is the cash available to both debt and equity holders,
Okay.
we start with our trustee EBIT,
Okay.
and we add back depreciation and amortization.
Depreciation and amortizations, those sound familiar.
Yeah.
Aren't they those non-cash expenses?
Right.
Related to the gradual wear and tear of assets over time.
You're on fire. They're accounting entries
Okay.
that don't actually involve any cash leaving the company.
Gotcha.
So we add them back to get a clearer picture
Right.
of the company's true cash-generating ability.
Okay, so EBIT plus depreciation and amortization.
Yes.
What's next?
Then we subtract capital expenditures, or CapEx,
CapEx, okay.
which are investments in long-term assets,
Okay.
like property, plant, and equipment.
Ooh, the big-ticket items that help a company grow and expand its operations.
Precisely. These investments, they're essential for long-term growth,
Right.
but they do use up cash in the short term.
Okay.
Finally, we adjust for changes in net working capital,
Okay.
which reflects the company's short-term assets
Mm-hmm.
and liabilities.
Networking capital. That sounds like a mouthful.
Think of it as the cash
Okay.
tied up in day-to-day operations.
Okay,
This
great.
example.
Yeah.
If a company extends more credit to customers,
Okay.
its accounts receivable will increase, and it'll need more cash on hand
Right.
to fund those sales.
So if a company's growing rapidly,
Yeah,
their working capital needs
right.
will likely increase too,
Correct.
which puts a strain on their cash flow.
Exactly. Managing working capital effectively, it's crucial for a company's financial health.
Right.
And once we've made all these adjustments,
Yeah.
we arrive at our free cash flow to the firm, or FCFF.
FCFF, the holy grail of fundamental analysis.
Yes.
Now, how do we use this
Right.
to determine the value of a company?
That's where the discounted cash flow, or DCF method, comes in.
DCF. Okay.
Remember, the core idea
Yeah.
is that a company's value
Mm-hmm.
is based on the cash it can generate in the future.
Okay.
DCF, it brings those future cash flows
Uh-huh.
back to their present value
Okay.
using a discount rate.
Because $1 today
Exactly.
is worth more than $1 tomorrow.
Exactly. The discount rate, it reflects the time value of money
Okay.
and the risk
Right.
associated with those future cash flows. And it's typically the company's weighted average cost of capital, or WACC,
WACC.
which takes into account the cost of both debt and equity financing.
So WACC is like a hurdle rate.
Yes.
the company's future cash flows
Right.
have to jump over
Yeah,
to create real value for investors.
you got it. Now, in a simplified scenario
Okay.
where the company's expected to generate cash flows forever,
Right.
the DCF equation becomes pretty straightforward.
Okay.
We simply divide the free cash flow to the firm by the WACC.
So if a company has consistent cash flow
Yeah,
and a low cost of capital,
right.
its value will be higher.
Exactly. But in the real world, things are rarely that simple.
Right.
Companies don't last forever,
Yeah.
and their cash flows can fluctuate wildly.
Yeah, of course.
That's why the more general DCF equation, which accounts for a finite number of years and varying cash flows, is more commonly used.
So it's like predicting the weather.
Right.
The further out we go, the less certain our forecast becomes.
A perfect analogy. And that's where the art and science of fundamental analysis really come together.
Yeah.
We need to analyze historical trends, understand industry dynamics,
Okay.
and make assumptions about the future
Right.
to project those cash flows.
Sounds challenging.
It is challenging, but exciting.
Yeah.
But before we delve deeper into DCF,
Okay.
let's take a step back
Right.
and look at the big picture.
Okay.
Remember those two components of a company's value, debt and equity.
Right.
The enterprise value, or EV,
Okay.
represents the total value of the company's operations,
Okay.
including both debt and equity. It's essentially what it would cost to acquire the entire company.
And this EV can be broken down into the market value of its debt
Right.
and the market value of its equity
Exactly.
or its stock.
Precisely. Each of these components can be valued separately,
Okay.
using similar principles to
Yeah.
the DCF we just discussed. The market value of debt
Mm-hmm.
is determined by the present value of future interest and principal payments.
So the value of debt is tied to the company's ability to meet its financial obligations.
Exactly. And the market value of equity
Yeah.
is determined by the present value of future cash flows to equity holders,
Okay.
which we call free cash flow to equity,
Right.
or FCFE.
FCFE, got it. So that represents the cash flows.
Yeah.
That's left over for shareholders
Exactly.
after all operating expenses, debt payments, and reinvestments have been made.
Right. And the cost of equity, or key,
Yeah.
is the discount rate we use to bring those future FCFE back to their present value.
Okay, so we have these different pieces of a puzzle. Debt, equity,
Yes.
cash flows,
Uh-huh.
discount rates.
Right.
How do we put it all together to actually value a company?
The course lays out a clear roadmap.
Okay.
The first step
Mm-hmm.
is to analyze the company's historical performance
Okay.
and strategic positioning, both within its industry and in the broader market. We need to understand what makes this company tick, what its competitive advantages are,
Right.
and what challenges it faces.
So it's not just about crunching numbers. It's about understanding the story behind the numbers.
Exactly. Then we need to project
Yeah.
those future cash flows,
Okay.
both FCFF and FCFE.
Right.
This involves making assumptions about revenue growth,
Mm-hmm.
profitability margins,
Okay.
capital expenditures,
Mm-hmm.
and working capital needs.
Back to predicting the future.
Right. But we're not just throwing darts blindly.
Yeah.
We're using all the information available to us,
Right.
combined with our understanding of the company and its industry,
Mm-hmm.
to develop a well-reasoned forecast.
Okay. And once we have those cash flow projections,
Yeah.
we need to determine the appropriate discount rate.
No.
Which involves assessing the company's risk profile,
Yes.
considering factors like its financial stability,
Uh-huh.
volatility of its industry,
Right.
and the overall macroeconomic environment.
Right. The higher the perceived risk,
Yeah.
the higher the discount rate,
Okay.
and the lower the present value of those future cash flows.
So it's a delicate balancing act between risk and reward.
Precisely. Once we have our cash flows and our discount rate,
Uh-huh.
we can calculate the present value of those cash flows and arrive at our estimated company value.
The moment of truth.
Exactly. But our job isn't done yet.
Oh, no.
We still need to compare our calculated value
Okay.
to the company's current market price
Right.
to see if it's overvalued or undervalued.
So it's all about finding those discrepancies, those opportunities
Exactly.
where the market hasn't yet caught up to a company's true value.
You got it. And the course provides a real-world case study
Okay.
using Ambev, the Brazilian beverage giant,
Oh, okay.
to show how these concepts are applied in practice.
Ambev, a company we can all relate to. I'm eager to see how the pros break down their valuation.
Me too. It's a great example of how to put theory into action
Mm-hmm.
and make informed investment decisions.
Well, we've covered a lot of ground in this segment, from the intricacies of cash flow
Yeah.
to the power of discounted cash flow analysis. I'm starting to feel like a true fundamental analyst.
Me too. But we're not done yet.
Oh, there's more.
In part 3, we'll explore another valuation approach using market multiples,
Okay.
which provides an alternative way to assess a company's worth. Join us as we continue our deep dive.
Welcome back to the deep dive. We've been on this incredible journey exploring, the ins and outs of fundamental analysis.
Yeah, we've learned how to analyze financial statements,
Right.
project cash flows,
Mhm.
and even calculate a company's intrinsic value using discounted cash flow analysis.
It's been intense,
Yeah.
but incredibly insightful.
Yeah, for sure.
But you mentioned that there's another way to value a company, right? Something about market multiples.
Yeah, so discounted cash flow analysis is a powerful tool, but it can be quite complex
Yeah.
and time-consuming.
Mm.
Sometimes we need like a quicker,
Okay.
more streamlined approach, especially when we're dealing with private companies
Uh-huh.
or when detailed financial projections are difficult to make.
Okay, I'm intrigued.
Okay.
Tell me more about this market multiples method.
So think of it like this.
Okay.
Instead of trying to predict the future
Uh-huh.
with, these complex cash flow projections,
Right.
we look at what the market is already paying
Okay.
for similar companies. It's like comparing houses in the same neighborhood.
Okay.
Like if a similar house down the street sold for $500,000,
Right.
we can get a rough idea
Yeah.
of what our house might be worth.
Okay.
We're using the wisdom of the market,
Mm-hmm.
the collective judgment of buyers and sellers
Uh-huh.
to guide our valuation.
Makes sense. But how do we actually find
Right.
those comparable companies
Okay.
and figure out which multiples to use?
That's where the art of fundamental analysis comes in.
Okay.
We need to consider factors like industry, size, growth prospects,
Mhm.
and financial risk
Okay.
to identify companies
Yeah.
that are truly comparable to the one we're trying to value.
So it's not just about finding companies in the same industry,
Right.
but it's about finding companies with similar financial profiles and growth trajectories.
Precisely. And once we've identified our peer group,
Yeah.
we can look at a variety of market multiples
Yeah.
to assess their valuations.
So the course material mentions a few categories of multiples.
Mhm.
What are those?
So the most common here are asset-based multiples,
Okay.
earnings-based multiples,
Mm-hmm.
and sales-based multiples.
Okay.
And each one
Yeah.
gives us a slightly different perspective on a company's worth.
Can you give me some examples?
Sure. One of the most widely used asset-based multiples is the price-to-book value ratio, or PB.
Okay.
This compares a company's market capitalization to the book value of its assets.
Book value being
Right.
the value of a company's assets minus its liabilities.
You got it. So a high PB ratio suggests that investors are willing to pay a premium for the company's assets, perhaps because they believe those assets are undervalued
Mm-hmm.
or have the potential to generate, strong future earnings.
Okay, so PP gives us a sense of how much the market values a company's assets.
Right.
What about those earnings-based multiples?
One of the most popular is the price-to-earnings ratio, or PE.
Yeah.
This compares a company's share price to its earnings per share, and it tells us how much investors are willing to pay for each dollar of earnings.
So a high PE ratio might indicate that investors are optimistic
Yeah.
about the company's future earnings growth.
Exactly. They're willing to pay a premium today
Right.
for the expectation of higher earnings tomorrow.
Makes sense.
Yeah.
Now, what about those sales-based multiples?
Okay.
When would we use those?
So sales-based multiples, like the price-to-sales ratio, or PS, are often used for companies with little or no earnings,
Okay.
such as, startups
Uh-huh.
or companies in rapidly growing industries. And they compare a company's market cap
Right.
to its revenue.
So it's a way to assess the value of a company's top line,
Yes.
its revenue-generating ability,
Mhm.
even if it's not yet profitable.
Exactly.
Yeah.
It's a useful metric for companies in the early stages of growth where earnings might not yet be a reliable indicator of value.
Right. Okay, I'm starting to see how these different multiples can give us, like,
Yeah.
a more well-rounded view
Exactly.
of a company's worth.
Right.
But how do we actually put this into practice?
So the course provides a great example.
Okay.
Using a fictional private company called LMC,
Okay.
which manufactures motors.
All right.
And the goal is to estimate a fair value
Yeah.
for LMC's shares
Okay.
ahead of a potential IPO.
So they're trying to figure out how much their company's worth
Exactly.
before going public.
Exactly. To do this, they identify a comparable publicly traded company called NEC,
Okay.
which operates in the same industry
Mm-hmm.
and has a similar asset and capital structure.
So they're using NEC as a benchmark to gauge LMC's potential valuation.
Right, using NEC's financials and market data.
Okay.
They calculate various multiples like price to earnings
Mhm.
and price to book value.
Okay.
And then they apply those multiples to LMC's corresponding metrics.
So if NEC is trading at a PE of 20
Yeah.
and LMC has similar earnings per share, they might estimate LMC's value using a similar multiple.
Precisely. Of course, it's not always that simple.
Right.
We need to adjust for differences in risk, growth prospects, and other factors.
Right.
But this example demonstrates how relative valuation can provide a practical way to estimate a company's worth.
It's like having a cheat sheet, but with the caveat
Right.
that we still need to use our brains
Yes.
and our judgment
Right.
to interpret the numbers.
Exactly. Relative valuation is a powerful tool,
Yeah.
but it's not a magic bullet.
Right.
We need to be mindful of its limitations
Okay.
and use it in conjunction with other valuation methods and our overall understanding of the business.
This deep dive has really opened my eyes to the complexities and nuances of valuing a company. It's definitely not as simple as just looking at the stock price.
I agree. And the course leaves us with a powerful reminder from economist Irving Fisher.
Okay.
He says, valuation is a human process in which anticipation enters. Future events cast their shadows before. Our valuations are always anticipations.
That's a beautiful way to put it.
Right.
We're not just crunching numbers,
Yeah.
but we're trying to grasp those shadows, those glimpses of the future.
Yes.
To make informed decisions about where to invest our hard-earned money.
Exactly. And that's what makes fundamental analysis so challenging and rewarding.
Absolutely.
It requires us to combine rigorous analytical skills with a healthy dose of intuition, judgment, and a willingness to embrace uncertainty.
Well, this deep dive has equipped us with the knowledge and the tools to embark on our own investment journeys, armed with a deeper understanding of what drives a company's value.
Absolutely.
It's been a pleasure exploring these concepts with you.
Thanks for having me.
Thanks for joining us on the deep dive. Remember, the journey of investing is a marathon, not a sprint.
Right.
Keep learning.
Yeah.
Keep exploring.
For sure.
And never stop asking questions.